Namaskar, Assalamu alaikum, good morning. Today I have brought up the checkpoints before you start a business. After doing the wealth accumulation as my previous videos, now the time that you think for a startup, because in a job scenario, every employee must think at a point that we should have something our own. But it is advised that you don't rush in without the right checks. And in this video, we share the essential step. This is the marking point, that essential step, what you have to check before launching a business. So, the first thing that you have to calculate return on investment, that is ROI. However, in the new terminology, new financial terms, there is one another term called IRR, but this is simple and easy to understand. So, return on investment we generally calculate yearly basis. So here net profit, so here you don't have started the business, so the expected, what you are expecting, the net profit into 100 by cost of investment, that means your capital. So this you have to calculate, and then return of investment in year. So here there are two methods to calculate. First, before a startup a business, before a startup a business, that is expected. Second thing, that you may acquire a business that is already running by someone else. So in the both cases, here the first one is net profit that you are calculating expected, and then the cost of investment. Here on another case, if the business is already running and you want to acquire it, in that case present value of the business, present value of all the assets divided by COI. COI means cost of investment, and then divide by with the same value and then multiply by 100. Here multiply is missing, but the multiply, especially it is happening in the real estate, because real estate the case is that you buy a flat supposed to be 25 minimum, not more, not less than that is the value. So 25 lakh, and in that case, I am talking about INR, so 25 lakh, but after 5 years, because of the location, the setup, the area that developed, so the value has went up to 35 lakh. So you are thinking that this area is growing area, this area is developing area, so we may invest at this location. So here the value has 10 lakh increased, and you are thinking this is the better place to invest. So what exactly you will, how you calculate this ROI percentage here? So ROI percentage is present value 35 lakh minus cost of investment was 25 lakh, that the paper you are saying, divided by 25 lakh. So this is the value you calculate, and then you understand that how many years it will take to get back your investment. The second thing is called break-even point. So investment value has been recovered fully. That point is called break-even point. After that, whatever the income, whatever the profit, that will be your business profit, and that will be your net earning. So here fixed cost divided by selling price per unit. Now it was a time earlier, because when we were making the project, we simply calculate that you will get your investment return or fully recovered at 2 years or 3 years. But now the business analyst said that in a year, in every month, the sales are not even, and maybe sometimes that it is going peak and sometimes it is the lowest. So when you are saying yearly, there may be some confusion, there may be some misconception. That's why they are saying, please tell me that how many units we sell. So if you are starting a factory or any setup trading, that you are selling in a unit, so they advise to calculate that how many units you will sell, then you will get your return. So here the fixed cost, it is your investment 10,000, then selling price per unit is $50, and variable cost per unit is $30. So here they are saying selling point minus variable cost, so fixed asset. So if you are going to this formula, forget real estate, now I am talking about the factory. So here if you are going for this formula to calculate, 10,000 is your fixed asset, and again this is not INR, this is USD. So both I am saying that you will be conversant that what is the exact thing to calculate. So 10,000 divided by, here this is the minus, so it is $50, that is your selling price per unit, and variable cost is 30. So if you are dividing this, so 10,000, and basically this one is used in the trading. So here 10,000 divided by 20. So here you will calculate 500. So this is advised that if you sell 500 units, you will get the break even point. So forget the year, forget the month, forget the week or something. If you sold 500 unit, your business came into equal, your business came into break even point, your investment recovered. So when you are starting making a business, just think that how many units if I will sell, I will get recovered my investment. Then the two things you already recover. The third point is working capital. So working capital, net working capital and working capital ratio, two things you have to calculate. The first one is current asset minus current liability. So here, as per everybody knows this, if the liability is more than the current asset, that means business will not survive. So for the survival of business, it is necessary that liability should be less than your asset. And then the ratio, so this how much to be less and how much is more to be sustainable. So current asset by current liability. So this is something, if you calculate it better, you will have the idea that how much you have to work on this and which area you have to make up. Then the operating expense, when you calculate this all, then there is operating expense. So operating expense, that is OPEX, day-to-day cost of running the business. Here there is always some confusion that how much cost will come and will occur when you are running a business. So here this is general funda, but there is always required some fine tuning. SGA means salary, rent, utility, office supply, insurance. These all are your regular expense whether you are selling or not selling. So SGA plus marketing, marketing means just advertisement. R&D for the research, that where you will get your raw material at easy cost. This is cheaper cost. This is the first R&D you have to do when you are starting the business. And then the other cost mostly the transportation, that is not covered because you don't know exactly during the R&D how much you are going to consume. The other cost means that you have not calculated initially. Then the profit margin. Now this one something that always calculated in the percentage. So net profit by revenue, everybody knows that this is the sales income, pure sales income, there is nothing minus, that is called revenue. So net profit minus divided by revenue into 100. This is important, this you must know by the peers company, by the similar company, that this business is running at how much profit margin. Like I am always saying that edible oil going on 3% profit margin, and the wood business is going 5%, milk business 8%. So something, so higher the percentage, lower the volume. If the percentage is less, the profit margin is less, then means you have to increase the volume. Then the new terms I learned myself. This is the burn rate. Burn rate means simply the cash flow, the cash outflow minus cash inflow. So this is it's especially important for the startup that are not yet generating positive cash flow, because when you are starting the business, you are only putting the money, you are investing, you are expensing, you are doing the money, returns are very less or sometimes no return. So investment use burn rate to estimate a company's runway. Runway means how much cash you have reserved, and the rate at the burn rate, how many months or how many years you will have no any issue. So here there are two things to calculate. Gross burn rate means total monthly operating expense. So it is a startup spend 50,000 per month on salaries, rent and marketing. Its gross burn rate is 50,000 per month. Means this is whatever you are you cannot avoid. This kind of costs are called cash outflow that you cannot stop. And at this rate, total monthly operating expense, this is called your gross burn rate. Then net burn rate. Net burn means, as I said, cash outflow minus cash inflow. So if a monthly expense are 50,000 and revenue, so here cash inflow means revenue. So if your revenue is 20,000, and initially it is similar to that, because I have taken this example based on so many experience, based on interview of so many owners, that how is going this. So 50,000 is your initial expense, monthly expense, and that 20,000 you are earning per month. So in that case, 30,000 is your burning rate. So now, before starting your business, you must keep at least, good is for 2 years, but if it is not 2 years, then you must think that 1 year this much money it should be in your stock. So 30 into 12, so 36 and 40. So 360,000 you must arrange before you are starting the business. Otherwise, as usual, the survey says that 80% of the business stops in first year. So take care and let me know if I am missing something. With you, I am growing myself as well. Thank you very much. Have a nice day. Please, please, please like my video so that I continue this kind of service. Bye-bye.